So good afternoon, Nicole, Nathan. This afternoon we proceed with our third lesson, which is the financial system. And there is a screen that I'd like to share for this purpose, and it's this one. Wait, what's going on? There, I hope you can see this. I hope you can see this. Okay. So you have the financial system where we are going to examine, one of the things that we'll examine is the flow of funds, as well as the flow of securities, notes, bonds and debt instruments. Later on, we will also look into the meanings of these words. If you look at this diagram, the dark lined arrows would represent the flow of funds, and it's in a cycle. As you can see, it really goes in a cycle. And a cycle is also given for the flow of securities, the ones represented by I think this is gray, by a gray lined arrow. And it also appears in a cycle. So if you talk of how funds flow in an enterprise, it's more or less going to start on financial institutions. Then it goes to savers, suppliers of funds. These suppliers bring it to financial markets. And then they'll be provided to users or demanders of funds. And these demanders of funds will in turn give it to financial institutions. There's also a case where financial institutions supply it to financial markets, or suppliers of funds by virtue of private placement provided to users or demanders of funds. And this financial system presents another cycle for the flow of securities. To further understand terms, we go into the heart of the discussion now. When a financial instrument is issued, it gives a financial asset and a financial liability or equity instrument. So, upon the receipt of an asset, of a financial asset, what also comes out could either be a reflection of a financial liability or an equity instrument. What is a financial asset? Let's start with that. Or better yet, we go with what a financial instrument is. Financial instruments are assets that can be traded, or they can also be seen as packages of capital that may be available for trade. Most types of financial instruments provide efficient flow and transfer of capital. These assets can be cash. Cash may be a financial instrument. You can also have a contractual right to deliver or receive cash, or evidence of one's ownership of an entity, for as long as it's an asset that is open for trading, or one that may be seen as a package of capital, making it available for trading. There are then lots of financial instruments. We begin with a financial asset. A financial asset is any asset that is, per definition, possibly cash. A financial asset is an equity instrument of another entity. It could also be a contractual right to receive cash or another financial asset from another entity. It could also be a contractual right to exchange instruments with another entity under conditions that are potentially favorable, as set by the International Accounting Standards 32. Subsection 11. Examples of these financial assets are notes receivable, loans receivable, investment in stock, or investment in bonds. If you talk about receivables, these are really your rights to receive cash from another entity. So a receivable is a recognition that another entity owes you a particular value. So you ought to receive something from another entity. That's why you term it as a receivable. That's your receivable. On the contrary, anything that you owe another entity Anything that you're supposed to pay to another entity is a payable. And that leads us to a financial liability, which pertains to any liability that is a contractual obligation, first, to deliver cash or other financial instrument to another entity, or to exchange financial instruments with another entity under conditions that are potentially unfavorable. Meaning, it is not, once it's termed potentially unfavorable, it is something that will decrease what the business possesses in exchange for what the business also obtained. Like, for instance, in the possession of one asset, for it to be obtained, something was given out. The unfavorable part there is, which is just to create a balance of records, the unfavorable part there is that something was released by the business. But this is really a process. That's really part of the process, because it is in recognition to create a balance. This will soon be reflected in the accounting equation, that once you actually receive something, you'll have to also part something with, you'll have to also give something out. Examples of these are notes payable, loans. If a receivable is anything that a company owes, that another entity owes you, what you owe to another entity referred to as a payable. So that's the better term there. We also have another term, which is an equity instrument, which pertains to any contract that evidences a residual interest in the assets of an entity, deducting all liabilities. So per equation, it's financial assets deducted with financial liabilities. Anything else that remains is what we refer to as equity instrument. Examples of them are ordinary share capital and preference share capital. These are just a few of the examples. So basically, capital stands as an equity instrument, as it is what's just remains once liabilities have been deducted from the assets of an entity. And when companies are in need of funding, they either sell debt securities or bonds, or issue equity instruments, those that indicate proofs of capital ownership. The proceeds from the sale of the debt securities and issuance of bonds will be used to finance the company's plans. On the other hand, investors buy debt securities of equity instruments in hopes of receiving returns through interest, dividend income, or appreciation in the final asset's price. So what is a debt instrument? Debt instruments, or a debt instrument, is a tool an entity can utilize to raise capital. It is a documented binding obligation that provides funds to an entity in return for a promise from the entity to repay a lender or an investor, as of course in accordance with the terms of a contract. These instruments generally have fixed returns due to fixed interest rates. There are two types of debt instruments. Here we have treasury bonds and treasury bills. You have corporate bonds as well. Treasury bonds or treasury bills are issued by, in our case, these are issued by the Philippine government. These bonds and bills have usually low interest rates and a very low risk of default, since the government assures that these will be paid. As there is a contract that determines the assurance of payment for treasury bonds and treasury bills, they are not that difficult to comply or to meet. So the risk is quite low. For corporate bonds, the assurance of them to be paid isn't there. That's why they are not risk-free. They're quite risky. These are issued by publicly listed companies. These bonds usually have higher interest rates, especially that they are not risk-free. If the company which issued the bonds goes bankrupt, the holder of the bonds will no longer receive any return from their investment, and even their principal investment can be wiped out. Equity instruments. What are equity instruments? Equity instruments are documents which serve as a legally applicable evidence of the ownership right in a firm or in any enterprise, just like a share certificate. When corporations or members of a corporation, when shareholders take part in the membership of a corporation, each of them receives actually a share certificate that is a title or that entitles that shareholder of his or her rights of participation and membership in that corporate structure. So that proves that that person is really a member to a corporate or to a corporate structure, and that it also stipulates the limitations of the membership of that shareholder, like how much voting right he or she possesses and some other things that can be enjoyed by him or her as he is a member of the corporation. Equity instruments are generally issued to company shareholders and are used to fund the business. It is, however, not necessary that the issued equity must return a dividend, for it is based on profits and terms of business. So let's remind ourselves again of this. Just because an equity instrument has been issued doesn't mean that there is already a vested return of interest, return of dividend, even if the equity instrument is given to the shareholder. The return of dividends can only happen for as long as there's a profit, or remember the lesson last time, for as long as there's available cash. These instruments generally have varied returns based on the performance of the issuing company. Returns for equity instruments come from either dividends or stock price appreciation. So you can have it taken from a preferred stock, which has priority over common stock in terms of claims over the assets of a company. This means that if a company were to be liquidated and its assets have to be distributed, no asset will be distributed to common stockholders unless all of the preferred stockholders have been given. Priority would be the preferred stockholders. Moreover, they have also priority over stockholders, common stockholders, in cash dividend declaration. So the priority would be for preferred stockholders, while common stockholders are there, even if they're the real owners, they will have to get their share of the dividend declaration once the preferred stock owners already had their turn. If the company's growth in spurring the common stockholders will benefit on the spurring, the common stockholders will benefit on the growth. Moreover, during a profitable period, for which a company may decide to declare higher dividends, preferred stock owner will receive a fixed dividend rate, while common stockholders will receive all the excess. And these instruments are then shared or sold in what we call a financial market. Financial market, from the term itself, is a type of market that provides an avenue for the sale and purchase of assets such as bonds, stocks, foreign exchange, and derivatives. Often they are called by different names like Wall Street or capital market, but all of them simply mean the same thing. Simply put, businesses and investors can go to financial markets to raise money to grow their business and to make more money, respectively. So we can call financial markets in several terms. We can call them a primary market or a secondary market. To raise money, users of funds will go to a primary market to issue new securities through a public offering or a private placement. The sale of new securities to the general public is referred to as a public offering, and the first offering of stock is called an initial public offering. However, suppliers of funds or the holders of the securities may decide to sell the securities that have been previously purchased. The sale takes place in secondary markets, like the Philippine Stock Exchange. The Philippine Stock Exchange both functions as a primary market and as a secondary market. Why is it that the Philippine Stock Exchange functions as a primary market? There are several entities or companies out there who place bonds or shares of their company to a public offering in the Philippine Stock Exchange. So that makes it a primary market. Another possible situation is that it functions as a secondary market because the suppliers or holders may decide to sell even if they've just purchased it. So what happens here is, assuming that Nathan has a company and then Nicole has bought the shares or bonds of Nathan's company, bought some shares or bonds from Nathan's company. So what Nicole then did later on was to offer in the Philippine Stock Exchange that's the shares that she bought from Nathan, now making the Philippine Stock Exchange a secondary market. Question so far?
What's gonna primary? Why is it
Primary.
on the BSE?
The PSE may function as a primary market because you may do this. Nathan, I'll use your name as an example, ha? Nathan is a company owner. And Nathan wants to expand, so he needs to have more shares. What Nathan will do is to look for companies in the Philippine Stock Exchange that are actually selling shares. So Nathan was able to buy shares from the Philippine Stock Exchange. Or there's another way of looking at it. Nicole owns a company. And Nicole is selling her shares through the Philippine Stock Exchange. So the Philippine Stock Exchange happens to be the first market to where shares can be bought. Another way of, the other situation is when the Philippine Stock Exchange becomes a secondary market. How does that work? Okay, here's the example earlier. Nathan is one company. Nicole bought some shares from Nathan. However, Nicole later on realized, I think I can earn more if I sell these shares that I bought from Nathan. So what will Nicole do? She will now place those shares in the PSE. But where did those shares originally come from? From Nathan. Therefore, as a secondary market, the Philippine Stock Exchange is not anymore the first market now that has sold the shares of Nathan. Because Nathan sold it first to Nicole. Nathan at that point was the primary market. He did a public offering. Nicole bought them. But later on, Nicole said, the ones that I previously purchased, I think I can still sell these. I'll sell them to the Philippine Stock Exchange. And then, Nicole, there were other buyers of these stocks. They bought the shares that Nicole sold. So Nicole now has earned. Nathan earned from Nicole, and Nicole now has earned from her selling of the stocks through the PSE. And at that point, Nicole made use of the PSE as a secondary market. Because the initial market was still Nathan. Aside from calling financial markets as primary or secondary markets, we can also look at them as money markets or capital markets. A money market is a venue wherein securities with short-term maturity. So when you talk of securities that mature in a short-term period, these are securities which mature at 1 year, in a year or in less than a year. Money markets are a venue where securities with short-term maturities are sold. They are created because some individuals, businesses, and governments, financial institutions have temporarily idle funds that they wish to invest in a relatively safe interest-bearing asset. At the same time, other individuals, businesses, governments, and financial institutions find themselves in need of seasonal or temporary financing. On the other hand, securities with long-term maturities are sold in capital markets. The key capital market securities are bonds with long-term debt and both common stock and preferred stock. So when you talk of bonds, they are sold in capital markets because they mature longer. If you talk of stocks, they are sold in capital markets because they are for longer maturities. Wait, I can't click. What happened there? In relation to these financial markets, we also have what we term as financial institutions. A financial institution is a company engaged in dealing with a business with financial and monetary transactions such as deposits, loans, investments, and currency exchange. Financial institutions encompass a broad range of business operations, including banks, trust companies, insurance companies, brokerage firms, investment dealers. So you have here examples of financial institutions. We begin with banks. Obviously, it is a venue that involves monetary transactions. This is where individuals deposit funds to be used, which use the deposited funds to provide commercial loans to firms and personal loans to individuals. They also purchase debt securities issued by firms or government agencies. So aside from receiving deposits, commercial banks also grant loans to firms and personal loans to individuals. Still, there's an involvement of some monetary transactions or monetary flow. Wait, I can click. Wait, what happened? Hoy. You also have insurance companies. Individuals purchase insurance companies such as life insurance, property, casualty, and health. Individuals purchase insurance protection with insurance premium. The payment is what you call an insurance premium. The insurance companies pool these payments and invest the proceeds in various securities until the funds are needed to pay off claims by policy holders. So someone who participates in an insurance company is a policy holder. The person just needs to wait, or the insurance just needs to wait when that policy holder is ready to claim the proceeds of the insurance. Because they often own large blocks of a firm's stocks or bonds, they frequently attempt to influence the management of the firm to improve the firm's performance and ultimately the performance of the securities they own. Mutual funds. These are owned by investment companies, which enable small investors to enjoy the benefits of investing in a diversified portfolio of securities. When mutual funds use money from investors, they finance new investment by firms. Conversely, when they invest in debt securities, they are already held by investors. They're transferring ownership of the securities among investors. Pension funds like SSS, CSIS, these are financial institutions that receive payments from employees and invest the proceeds on their behalf. So you have here the ones that I mentioned, SSS, GSIS, the Unit Investment Trust Fund, and among others. Going back to insurance companies, I think I'm not sure if you have already been you have already, or your family has participated in the payment of an insurance fund or insurance company. Have your families participated in that? What about PhilHealth? No PhilHealth?
Sir? What
No
again,
PhilHealth.
sir?
What about PhilHealth?
Meron, sir.
Oh, PhilHealth is actually a form of insurance. Funny thing.
Insurance? Meron, sir, meron.
Oh. What about yours, Nathan? And then your the policy holders, or the ones who have participated in them, can only claim the proceeds of these once a situation comes, or once the terms have matured. Like for instance, what was that? There is one that introduced to us. It's an insurance company that introduced, when I was still in another school, there was an insurance company that presented to us some terms of their insurance, that all proceeds of it can be enjoyed by the policy holder after 5 to 10 years. Or the person may opt to still have the proceeds be deposited and only claimed when necessary. Unless, of course, the person just wants to claim it after some point in time, after 10 years or 5 years. So that's how insurance companies work. And they sound quite inviting, actually. They sound really quite inviting. By the way, please do not be surprised if, as of this time, our discussions are still too theoretical. You might have really noticed it by now. We are still in the theoretical aspect of these concepts. By the time we finish the theoretical discussions for business finance, and even in accounting, we will proceed into analysis, interpretation, and computation, analysis, and interpretation of financial documents, of financial reports. Now, please go to your Edmodo page. I'll be posting some questions there. I hope the Edmodo will not have any problem or any glitch. Because just earlier, I had a difficulty posting the notes for Module 3. By the way, have you both seen already the module for Module 3? Have you downloaded it? Okay.
So, another example here, a tall allele will be represented by a capital T, a short allele will be represented by a small letter t. How do the genes look like? How are genes expressed, class? Genes are expressed here. And homogeneity or heterogeneity. Homogeneous pairs are what we call as pure breed. Heterogeneous pairs are what we call as mixed breed. So what are these homogeneous pairs? It could be homogeneous dominant or homogeneous recessive. I hope that the next slide will show this. Okay. Here is an example of pure
There's something wrong for a while.
tall individual. So the paired allele will be pure will be all capital T. And this is a homozygous dominant. Okay? This is termed homozygous dominant. But if both alleles are small letters, which is pure recessive, then we call this homozygous recessive. Pure recessive or homozygous recessive. Pure dominant or homozygous dominant. Homo means the same. Zygous, gene pair. Homogeneity. How about heterogeneity? We only have one heterogeneity class.
The first question is already there. Why are equity instruments significant in the life of a corporate structure? I hope you can now find the question.
Allele class. The presence of a dominant allele and a recessive allele, which do you think will be expressed as a trait? Is it the capital T or the small letter T? Yes, Anthony. Looking closely to the example of a heterogeneous allele, with the presence of a capital T and a small letter T, being the heterozygous allele. If this is heterozygous tall, what would be
Question number 2 is already there. Why are financial markets helpful in the life of a business?
Be tall or will the individual be short? Either way. That's a good answer actually. Depending on the situation. Because we can consider that we have the so-called codominants and incompute dominants. Later on we'll discuss it further. But if there's no such thing as codominants or incompute dominants, with the presence of a capital letter T and a small letter t, what will overpower as a trait, what will be expressed is the trait of a capital letter, which is the dominant allele. Okay? Even if this is a heterozygous, but the trait of an individual allele is a tall individual. Oh, here. A heterozygous tall with a dominant allele T and a heterozygous allele T will look tall. So it's not in between. Is the person tall or short? And it will be probably not all the time. But if this will be in an expression, then the express trait will be tall.
The third question is also there as well.
How can we predict an offspring class? Using the alligates, we can predict actually the offspring directly.
So the first question again is, why are equity instruments significant in the life of a corporate structure? So there's a specification here in number 1 that equity instruments are really for the corporate structure. For number 2, why are financial markets helpful in the life of a business? Number 3, how do commercial banks function as financial institutions?
Energetic. A female gamete contains capital E and a small letter E. Therefore, the female is heterozygous energetic.